If you want to know where we're at in this Bitcoin bull cycle, then this episode is for you. I've been following my next guest's work for a very long time now. I love his insights and tweets. So welcome to the show for the very first time, Jurrien Timmer. He's the Director of Global Macro at Fidelity. Thank you so much for joining me.
It's great to be here. Thanks for inviting me.
Well, before we get into all of the Bitcoin and macro side, let's talk a little bit about your origin story. I would love to know where you're from and how you ended up at Fidelity.
Well, it's been a journey, but I was born and raised on the island of Aruba as a Dutch citizen. My parents lived there for a long time. They retired back to Holland, and so,
Wow.
but I still go to both places a lot. So I've got family sort of all over the world.
Amazing.
But came to the U.S. to go to college back in '81. Became a U.S. citizen in '02.
Wow.
And have been working for Fidelity here in Boston for the last 29 years.
Oh my gosh. Well, and so were you always interested in finance? Did you study economics? Like how did you get to be doing what you are?
Well, when I was in high school, I wanted to be an architect. And I still have drawings from like when I was a kid of houses that I would draw. But then I figured, I don't know if I'm going to be any good at this. So let me just go to business school and get, a finance degree, which I did. And then it was really a matter of, as a non-U.S. citizen, I needed, a work permit. I mean, it's a familiar story to many people. And, I blanketed the world with applications, and I got one job offer, and it was at a bank in New York, and they were willing to go to bat for me a little bit. I had to kind of bluff my way into it, but I got this job like 2 weeks before I graduated. So it was really that close. I almost had to go to Holland and work there, and so I kind of fell into finance. I mean, I did get a finance degree, but I went to work for a Dutch bank, and being a banker was like the last thing on my list. And I'm not a banker, but and then things kind of moved around. And after a few months, this bank opened up a capital markets desk, and I ended up trading bonds. It was that was the day of Euro bonds, like a dentist in Holland would buy Eurodollar bonds, and we would execute the trade. And so I cut my teeth in the bond market in my first months out of school. And actually that was a really important foundation, because you can't understand anything in the market if you don't understand how the bond market and how interest rates work. And so it was a very valuable sort of education. But that's sort of how it started. And then I was there for 10 years, and then I came to Fidelity, and now I do sort of every asset class on the planet.
It's amazing. There are so many bond experts or people with that type of experience in the Bitcoin industry who have made their way here and believe that Bitcoin will underpin the future system. So that's fantastic to hear. And I love stories where it's kind of like you fake it till you make it. Always say yes to the opportunity because you can learn later, right?
Yes, for sure.
Okay, so you specialize in asset allocation and macro at Fidelity. And your work, I mean, we're going to cover so much ground here. But Fidelity, a lot of my viewers are familiar with the fact that the company has been in Bitcoin for a very long time. I mean, mining back in 2014. So can you talk to me a little bit about when you first were exposed to Bitcoin and maybe the journey that you've seen the company go on to now just recently having an ETF approved?
Yeah, so I wouldn't say we're OGs in the Bitcoin space, but we have been involved in the space for a long time, since 2014, as you indicated. I kind of went in down the rabbit hole in 2020. So I'm a TradFi, person, operating in this 60-40 world. And it's like anything else, right? Something new. When it first comes out, unless you're really sort of in the weeds, you're like, okay, fine. It's interesting, but am I going to spend a couple of 100 hours, understanding this? And as you know, you can't understand Bitcoin unless you spend a long time, trying to pull back the onion, because otherwise you'll never have the conviction of owning it through all these big, bouts of volatility. You would be out immediately and like, okay, well, that was a painful lesson in momentum chasing. And so you need to do the homework in order to have that that the stomach to withstand those 80% drawdowns that happened. So in 2020, of course, we had the pandemic. Bitcoin went from 3,000 or 4,000, and it mooned, of course, and so this was now whatever, the second, third time that we had one of those big moonings, and it's like more and more people are asking me about it, and because I'm the macro strategist, and people are asking, I'm like, okay, it's time for me to understand this. And there's a lot of great information on Twitter or X and social media, but there are also a lot of very strongly held opinions where you don't really know like how valid they are, right? I mean, so I'm like, okay, if I'm going to do this, if I'm going to go and speak to investors as this person at Fidelity, I better know what I'm talking about. And so I started. And I did, I read all the research. I looked at Plan B and like the whole like stock to flow. And I'm like, okay, let me at least start there because, that was all kind of open source. And then I started looking at, okay, so that was the supply side. But, as you know, the stock to flow stuff, it did a great job explaining the origins of kind of that parabolic origin. But then it sort of goes pie in the sky, and to me that didn't really sounded that reasonable. And so then I started looking at the demand side. I'm like, okay, well, this is an exponential curve. I've seen those before. I mean, I created S-curve charts back in 2000 to plot the rise of emerging markets like China, India on that curve of industrialization. So I'm familiar with the concept, and I'm like, okay, well, let me go down that route. And so anyway, that's kind of how the journey unfolded. And I wrote a paper in early 2021, and from that point on, I've been sort of in the mix of people crossing over from the traditional world of investing into the world. I wouldn't say of crypto, because I really just look at Bitcoin, because to me, Bitcoin is unique, right? I mean, other crypto stories are unique, but to me, Bitcoin is really unique because it has the supply characteristics of gold and the demand characteristics of like a network, and that's pretty cool. So I kind of stayed there, but I think it's been an interesting thing to contribute to, just because for the average investor, or even the non-average investor, the question is, okay, here's this shiny thing. It looks really cool. It's exciting. I either have a religious belief about it or not, but then what? Like, where does it go? Like, how much should we have? Like, where does it come from? Does it come out of bombs? Go out? Like those are then all the questions that I try to really focus on, rather than, Bitcoin goes to here or it means that. It's just, okay, if you've taken the leap, then what? And that was what I was trying to bring to the equation.
Coin Stories is brought to you by Bitdeer, where the power of Bitcoin mining is at your fingertips. As a publicly traded leader, Bitdeer's global reach and scale means they're everywhere you need them to be, ensuring you're part of the thriving Bitcoin economy. Bitdeer's not just mining, they are industry pioneers, and Bitdeer stands alone as the only vertically integrated, technology-focused Bitcoin mining company. What does that mean? Well, they're not just deploying, but developing the latest tech to make Bitcoin mining more efficient and effective. And with the industry's most experienced leadership team, innovation is in their DNA. And it shows. A quarter of their workforce is dedicated to research and development, pushing the boundaries of what's possible in Bitcoin mining. Now they're leveraging years of expertise in data center and cloud management into high-performance computing through a recently announced partnership with NVIDIA. Join Bitdeer in reshaping the world of Bitcoin mining. Learn more at bitdeer.com and explore how they are pioneering the future today. Well, let's dig into some of that, because I think a big question on people's minds, especially if they're coming into Bitcoin very new now, they're looking at these ETFs, it's like, how much do I allocate? And you mentioned a little bit ago the 60-40 portfolio. That was sort of the way that everyone invested. And I'm curious your take on how that's evolving and how Bitcoin does fit into maybe the portfolio of the future, as globally macro things have changed a lot in just the last couple of years.
Yes, they sure have. And, the 60-40 paradigm really was born in the late 90s or so. And what happened then was that the correlation between stocks and bonds flipped to negative. So it had been positive for a number of decades. And in the old days, which a lot of investors kind of didn't realize until a couple of years ago when it started happening again. But in the old days, we're used to there being episodes of volatility in the stock market, and then the bond market is that port in the storm, right? So it's a reprieve from volatility in the stock market. In the old days, it was really the other way around. It would be rising rates that would create wobbles in the stock market, and the most infamous episode of that was the 87 crash, where rates were rising, the Fed was hiking, and the stock market completely ignored it. And this old thing called the Fed model, which Alan Greenspan, used to talk about a lot, where you compare the earnings yield to the bond yield, or the PE in the stock market to the PE of the bond market, which is the inverse of the yield. When those two stretch, so they trade in harmony most of the time, and when they stretch, there's it's like a coiled spring. And so back in the days, it would be increases in rates typically happening because the economy was overheating and inflation was rising, the Fed was tightening. That would create corrections in the stock market. We're back to that kind of being the case, right? 2022, of course, was textbook. The bond market was the source of volatility for the stock market. The stock market fell 28% without earnings going down. It was all valuation. And that's an important lesson, right? The Fed has the ability to reset the cost of capital for everyone. Valuation is the present value of future cash flow. So if the cost of capital goes up, the present value goes down. And that, of course, was 2022. But even last fall, we had another episode where the 10-year yield went to 5%, caused a 10% correction in the stock market. And even the last month or two, the same thing happened in a smaller scale. The 6% decline we saw in the S&P, again, bonds were kind of at the source of that. So long story short, we've had this great reset now in 2022. Bonds went from 0.5% to 5%. And when you express that as a PE, the PE went from, at its extreme, it was 300 times the cash flow of a bond, right? When the yield was 0.3%, very briefly in March of 2022, you invert that, you get a 300 PE. The PE on bonds is now 22. So the good news is that bonds offer value again. They are a competitive asset class. When you strip out inflation of 3.5, you're still getting a positive real yield. But the caveat is that they're now positively correlated. And there really isn't anything that is sharply negatively correlated against the S&P. I mean, Bitcoin has a slight positive correlation. Gold is uncorrelated. You can get into alts, managed futures and hedged equity and things like that. They have kind of more or less zero correlations, but there is nothing anymore that is negatively correlated to the S&P, and so that removes a big anchor from that 60-40. Even though there are still reasons to own the 40, right? I mean, you're still getting a real yield. The volatility of bonds generally is less than of stocks. So I'm not saying there shouldn't be any bonds in there, but in 2020, of course, when the policy response to the pandemic was so extreme, right, both on the fiscal side and the monetary side, obviously Bitcoin immediately responded to that, gold to a lesser degree. And at that point, when you were looking at 1% nominal yields and rising inflation, you're like, okay, not only are bonds no longer, they were still negatively correlated, but the real return was negative. And so the reason we talk about gold, and when I went down the Bitcoin rabbit hole, actually, I should have mentioned this earlier, I started with the premise of, okay, well, we know what gold is. It's a store of value. When the government takes away purchasing power through negative real rates, you want to have these inflation hedges. And so is Bitcoin another player on that team? And that's kind of how I pose the entire question. And so in 2020 and beyond, gold, silver, Bitcoin are all, in my view, different players on the same team, but they have different attributes. I've called Bitcoin as exponential gold, if you will, because it has that exponential feature that gold does not have. And to me, they should all be on the menu, right? And whether someone actually orders from the menu is up to individual, preferences and tastes. And I mean, and again, if you're going to put it on the menu, you should understand what it is and what the Sharpe ratio characteristics are. It does have a 70 vol. It has a very competitive Sharpe ratio to the S&P or even the 60-40 from the old days. But obviously, you need to be prepared that the drawdowns, it is a boom bust type of asset, at least at this point. My guess is it will eventually mature into something less than that, just the way that gold did after it came of age in the 70s. But to me, the current modern version of a 60-40 is much broader than the old version. So until a few years ago, you really didn't need to do anything more than have some S&P and some investment grade bonds, and nothing else really added to that mix. And I think we're now in a period where that is no longer the case. So we can think of commodities, gold, Bitcoin, cash, high yield bonds, bank loans, tips, alts such as managed futures or CTAs, absolute return strategies. So to me, a 60-40 is really more like a 50-30-20 or a 50-20-30, right? Where there's now a large bucket of other, and then it's a question of, how much of that other does Bitcoin occupy? And of course, that comes down to individual taste. How much of a drawdown can you stomach? Because, and this is not unique to Bitcoin, but one of the challenges for investors when you create a portfolio is, you want to have a plan. You want to build that portfolio that's right for you, where you're on the right side of the efficient frontier of return versus risk, right? You're trying to maximize the return for every unit of risk, if you will. Once you've done that, which is not that difficult to do, the most important thing is to actually stick with that plan. So you don't want to have so much risk in the portfolio that all of a sudden you're facing a drawdown, and then you're going to run for the hills and sell when you should not be doing that. And so that is a part of kind of of a sanity check of having a portfolio that you can live with during those times when it's not going to do what you want it to do, which is fairly often, right? The stock market only goes up 60-70% of the time. And so to me, that's kind of where the Bitcoin question comes in. And is it 1%? Is it 2%? Is it 5%? Those become individual questions of sort of risk return optimization. But a little goes a long way, because that Sharpe ratio is potent, but the numerator and the denominator of that Sharpe ratio, that risk adjusted return, are both very high.
Well, I'm glad you mentioned that, because it makes me think about one of your tweets where you showed Bitcoin on a chart of risk-adjusted returns, and I think you said something like it's out of this universe. So can you talk a little bit more about how it has benefited traditional portfolios despite the fact that it has these massive drawdowns? I mean, really, the volatility has been a feature, not a bug.
Yeah, yes. And I think the volatility will remain a feature. So when you have a clear supply cap, and you can't sort of mint coins whenever the demand goes up, which of course is what also is the appeal for gold. But in theory, you could mine more gold, or you can pump more oil, like if the demand goes up. Obviously, for Bitcoin, that is much more limited. That is in part what creates the volatility, because you have this inelasticity of supply and demand. So it is very much a feature and not a bug. And of course, volatility, when people think of volatility, they think of downside volatility, but volatility can be upside volatility as well. And that's why looking at the Sharpe ratio, so the return over the volatility, is a good metric, as well as what would hypothetically be your worst drawdown on, if you have 1% Bitcoin or 10% Bitcoin or what have you, and to kind of stress test all of that. And we did a lot of that work, and we published a paper on it. And, the answer, and again, no, there is no cookie cutter response. Everyone's going to be different, but, a couple of percent will make an impact. Obviously, more than that would make more of an impact, but then you get into that duality of, okay, you need to be able to handle the drawdowns as well. But at a couple of percent, that seems to be an area where the risk reward, where it's enough to matter just because of the return profile that we've historically seen, but not so much that it's going to make you want to sell everything when it goes against you. And that is that intersection. And this is not unique to Bitcoin, but that's the intersection of a portfolio that we always have to think about.
A lot of people feel that the ETF approval this year was really a landmark, that this really starts the era of institutional adoption. And we've seen it, but the interest and demand has mostly come from the retail side. Is that something that you're watching closely? And when do you expect more of these institutions and maybe some major players out there start to allocate to Bitcoin?
Yeah, it's a good question, and certainly there was a lot of, I don't want to say hype, but there was some hype around the anticipated launch, and of course, we're very much part of that. I mean, we've had a really successful launch as well, and I'm very proud of our team here about how they did that. So it's been a great story. But when you look, for instance, in the spot market, you see the flows into these ETFs and ETPs. But if you look at the futures market, there was a massive jump in open interest starting last fall, and it only came down really a few months ago. And so, it's so that there's always going to be some hype that is just hype, that people are along for the ride. Tourists are just kind of saying, okay, this is an adoption wave. I'm gonna jump on and maybe sell the second that it goes against me. And when you look at the futures market, you go to the CFTC reports, the Commitment of Traders report, and you look at Bitcoin futures, you see a massive increase in open interest, and that isn't really explainable by these ETFs, right? So it's never going to be pure, right, people? And of course, this is very much part of Bitcoin's history, not just Bitcoin, but all digital assets, is that you do get these boom bust cycles, right? So there's something real going on. You do get that adoption, but that doesn't mean that the crowd is not going to jump on there and play the momentum game. So, but it is a form of democratization, I think, of Bitcoin. You don't have to remember passwords and keys and things like that. And of course, Fidelity, self-custodies, our product. So it does give investors an easier opportunity to participate in the spot, right? Because the futures, I mean, of course, there have been futures ETFs, but then you got roll yields, you got all this other math that often works against you in the commodity space. And I think Bitcoin, I view it as a commodity currency. And so this is a good way to increase, it's a good way for Bitcoin to get on the menu for basically any investor, as opposed to only being on the menu for highly sophisticated institutions that were willing to go and self-custody their Bitcoin. So it's easier now to just say, okay, here's a menu of an investment portfolio or a trading portfolio, and now Bitcoin to me is right next to gold on that menu, and say, okay, to me, Bitcoin is an aspirational store of value. It's an exponential version of gold, and that's how I view it. Other people view it differently, I'm sure, but that's how I view it. So when I think about financial repression, let's say the Fed keeps real interest rates below zero, which it's not doing right now, but it was in 2020, and maybe it will do so again. Or we're in this era of fiscal dominance where the government is running 6% deficits, even though the unemployment rate's at 3.9%. Where does that become a fiscal spiral that you can't get out of. And in that sense, will money supply just keep growing and debase the currency? And that's, to me, that's where hard assets, and it doesn't have to be just Bitcoin or gold. It can be real estate, it can be equities. Equities are a store of value as well. To me, that's how I think about what that does, and having these products available to everyone, I think is useful, so that if people are doing that math for themselves, or they're sitting down with their financial advisor and they say, I want to have some protection here, at least now it's a contender to easily be able to do that. But I do think investors have to be smart about, just because there is now a spot product out there doesn't mean you take away the boom bust cycles. That's still going to happen.
I want to circle back to your analysis on fiscal dominance and Fed policy, but I have to ask you, there are some people out there who have such a strong conviction in Bitcoin that they really do believe that it's going to eat into every other asset class so significantly, to the point that it will demonetize real estate, it will demonetize equities, so that the valuations aren't so crazy compared to how much they earn. It will eat into bonds, which are now more of a risky asset than they once were. I mean, they have default risk and they have the inflation risk, because they're going to probably debase the currency over the long run. So what do you think about the people out there who think that everything is going to sort of funnel eventually to Bitcoin being the most dominant macro asset that has taken the majority possibly of a lot of these other asset classes?
It's a great question, and I have friends who think exactly like that. I run. This is completely off topic, but I run a food camp at Burning Man, and we have a few Bitcoin enthusiasts in our camp, and it's actually so it's always really entertaining and interesting to talk to them, where they one person literally does not trust the dollar enough to keep his cash in dollars, so he puts everything in Bitcoin. So anyway, so I hear you in recognizing that spectrum of opinion is out there. To me, your question is a good one, and it raises the question of valuation, right? So we have price and we have value, right? Price is what you pay, value is what you get. And so I don't see that happening the way you describe, at least not to that extreme, because at a certain point, Bitcoin would become so expensive, right? I mean, I'm not going to throw out any price numbers, but if the price of Bitcoin goes, like, of course, one of the challenges with Bitcoin and gold is that it doesn't have a cash flow. So how do you value it, right? But you can think about valuation metrics. For gold, you can think about its market share of the money supply when the money supply grows too fast. Like, you can come up with metrics where you don't need a cash flow. And for Bitcoin, of course, it's the size of the network. Networks have value. It's Metcalfe's law, and you can also create like a price to network ratio, which I did, like the price of Bitcoin compared to the number of non-zero addresses, for instance, and you can come up with sort of PE ratios there. But in your scenario, if you take that to an extreme, at some point, a bond would be yielding 10% instead of 5%, and Bitcoin would be at 10 million or whatever the number is, and or gold is at 2,000 and Bitcoin is at 1 million. At some point, investors are going to say, all right, I understand the direction in which this is going, but these other asset classes that are on the other side of this pairs trade are really becoming cheap, while this side is becoming expensive. And so I do think at some point, the relative valuation of traditional asset classes and Bitcoin will bring people back into those asset classes. So I do think mean reversion will set in, and let's say a big hedge fund made that trade. At some point, the S&P is trading at 8 times earnings. Is like, you know what, I'm not going to leave that on the table, and they'll flip back. That's my guess.
I do think that a free market is the best referee always, although we don't really live in one, not in my opinion. So let's talk a little bit about, Fed policy, fiscal dominance, because it seems like although they've turned down the spigot on the monetary stimulus side. They've increased it on the fiscal, and we're running these massive deficits. We're not even officially in a recession. How do you think this is going to impact not just Bitcoin, but really the greater economy? Because at some point, I mean, a lot of analysts are forecasting that we just have to go over a cliff. They're able to sort of keep things in place right now and held together. But I mean, the consequences of all this monetary stimulus and intervention is eventually going to come back around. What's your take? It's time for a quick break to hear these messages from my partners who make this podcast possible. Next up, Bitcoin 2024, the world's largest Bitcoin conference, is coming to Nashville this July. Join us for 3 amazing days of keynotes, panels, networking events, and my Women of Bitcoin brunch. The Bitcoin conference is where I launched my podcast 3 years ago. You never know what can happen or who you can meet here. Head to b.tc/conference and use the code HODL for 10% off. Next up, Speed Bitcoin Lightning Wallet, one of the fastest growing Bitcoin wallets out there. Speed is a secure, low-cost way to send and receive Bitcoin instantly. It's super simple and scores high user ratings, and you can even use it to shop gift cards of your favorite brands to earn rewards. Download Speed using the QR code on the screen or the link in my show notes. Next up, Coinkite. Coinkite makes everything you need to safely self-custody your Bitcoin, including the Coldcard wallet. That's the cold storage device I use for safekeeping my Bitcoin. You can verify the source code, it's ultra secure, and it's easy to use even if you're a beginner. Head to their site in my show notes and get a 5% discount with promo code CoinStories. And finally, the why of Bitcoin is easy to grasp, but the how can be so confusing. The Bitcoin Way is a professional Bitcoin IT and security team offering personalized one-on-one support that guides you through cold storage, setting up nodes, inheritance planning, privacy best practices, and more. Don't take my word for it. Take 82-year-old customer Bill's.
Give the Bitcoin Way a try. You will be well on your way to owning and protecting the greatest money ever discovered.
Set up your free 30-minute consultation today. All right, back to the show.
Yeah, it's, it is one of the existential questions of our day. And I think it's a good thing that the Fed is leaning into or against the fiscal dominance, right? Because I've studied a lot of history. I've studied the 1940s, the 1960s. I know like Lynn Alden has done a lot of work on that as well. She's great, by the way. And back in the 40s, the Fed did the Treasury's bidding, right? I mean, the Fed was not independent yet. That happened in 51. Obviously, World War II happened. The debt to GDP went to 120%. And the Fed's job was to make that debt fundable, right? And so the Fed protected 2.5% on the bonds that were issued. Sorry, it was defending par at a 2.5% yield, and that was sort of seen as a contract with the bondholders who were the ones funding the war, and it was largely successful. And the Fed actually enticed the banks to do most of its heavy lifting for it. It created a very steep yield curve. And the banks just said, you know what, I'll sell you my T-bills and I'll buy long bonds and I'll make a spread of 200 basis points, and we'll do that all day long. And that regime ended in the 50s, but inflation did not come roaring back, at least not until the late 60s. But the late 60s was another example where the government was running persistent deficits. So that was the era where full employment was a big focus. Of course, that was also the era that entitlement spending started to happen. There was a period of social unrest, civil rights, all of that stuff that kind of have some echoes to what we've had in the last few years. And the Fed was kind of asleep at the wheel, if you will. So you had all these deficits. The Fed did not appreciate the threat of inflation. And in actually 1966, there was a wobble and the Fed pivoted prematurely, it turned out, and it had to take back those rate cuts and then raise rates some more. And I mention that because I think the reason why the Fed is rightfully very reluctant here to give back some of the rate hikes from 2022 is because it knows that it made a policy mistake back then. So the Fed is restrictive. The fiscal side is very, very loose, right? 6-7% deficits at a full capacity economy, basically. And that juxtaposition is actually keeping the dollar quite strong, right? Because you have high real rates, high nominal rates, but a lot of economic strength coming from the fiscal side. We saw that in the early 80s, and that was a strong dollar period as well. Now, if you take that same situation and take away the restrictive monetary side, you get to what Japan is doing, which is, fiscal spending, financial repression, zero rates, and look at what's happening to the yen, right? It's just, I think it's making a new low right now, 157. And so that gives you a taste. I mean, Japan is not the dominant reserve currency the way the US dollar is, but it gives you a flavor of what would happen if you had true fiscal dominance, where you had lots of deficits funded by the central bank. I mean, maybe not outright monetary debt monetization. It can be indirect. It doesn't really matter. But the currency, you can manipulate some parts, but ultimately something is going to give. And in that case, it's the currency. And of course, this is part of what you read about in the narrative for Bitcoin and gold as well, is that dollar, de-dollarization, dollar's going to lose its reserve status because of this fiscal dominance. And it hasn't so far. It's losing its status as a reserve currency. In other words, the percentage of global reserves that is in dollars is going down. It's down to 58%. It was in the 60s a decade ago. But the dollar is surprisingly strong in the face of that. And I think that's resulting from this monetary and fiscal being on opposite sides. So, but to take the question to its logical conclusion, which is that eventually, the chickens will come home to roost, or whatever the expression is, that rates would rise, the term premium would come back in the bond market, and it would become more and more expensive to fund all this debt, right? The government's already spending $1 trillion on debt service, and not a lot of the budget is discretionary, right? When you add up entitlements, defense, and debt service, there's not that much left, which is why this is not really even much of a political question in an election year. Mm-hmm. And so, and with all the unfunded liabilities that are out there, it's really hard to see an end game in this that does not involve some form of financial repression. Either the Fed will have to support the bond market indirectly, right? It doesn't have to necessarily do QE, but it can come in, like when the market gets really messy, it could come in and kind of do like a cleanup on aisle 5 type of thing, the way the Bank of England did a couple of years ago when the gilt market was starting to unravel. So it could be kind of targeted ways of restoring order to the market, which actually is part of the Fed's job, is to maintain orderly markets. It could also regulate the banks, right? It could say, I mean, it already regulates the banks, but it could create regulations could be created that force the banks to hold more reserves at the Fed. And the Fed could say, we're not going to pay you interest on those reserves. Well, now all of a sudden the government's got free money to increase the debt even more. So we don't want to discount the creative, potential of how policymakers can thread this needle. But it's very easy to see the allure of hard assets, stores of value, when you're looking at kind of an untenable fiscal loop as far as the eye can see. I mean, historically, the government either grows out of debt like it did after World War II. Obviously, you could have austerity, but that's generally politically not very popular, and in this case, not even feasible unless you cut entitlement spending. Or you inflate your way out, and if it's other countries that so if like the U.S., obviously the Chinese own our debt, the Japanese, other countries own our debt. But when you have, like, let's say an emerging market country where most of the debt is owned by people from outside that country, then of course currency debasement becomes a strategy, well, either a strategy or an outcome. For the U.S., I don't know how clear that part of it is, but if auctions start to fail or the market gets messy and the Fed has to add reserves, you could argue that's sort of a backdoor monetization, or at least a monetary inflation. And one thing we know from gold is that it responds to monetary inflation, and Bitcoin might, if Bitcoin is a player on that same team, you could connect the dots there.
Well, I agree with you that policymakers and central bankers, they can get very creative. And as I listen to you, I just think about how much manipulation is at the core of our system. And really it requires it at this point, because we've gotten so far into this debt cycle that we need more credit. We need liquidity in order to keep things juiced and running, which again is the allure for things like Bitcoin. But you mentioned the election year and you did some interesting threads about that. I'd love for you to touch a little bit more, because this year they have even more of an incentive to make sure that things really don't come loose and unhinged, right? So some people were predicting that we would go over a cliff and there'd be some massive deflationary bust this year, but I don't think so, given the fact that they want to remain in power.
Yeah, so the election cycle, which I've studied going back to 1789, I wasn't around 1789, but I studied the history, has a clear pattern where the first 2 years of an election cycle, presidential cycle, tend to be below average, and the last 2 years tend to be above average. So that's the presidential cycle. And the reason apparently is that, when a new party is voted into power, regulations get enacted, policies get enacted, and some could be bullish for the market, but others could be bearish. But generally speaking, the stock market, they like gridlock. They like kind of a hands-off approach. Like, don't regulate. We can manage our business. You don't need to step in and tell us how to do it. And so that's the argument of why the first year or two can be below average, because that's when things are changing. But then the second half, the parties just want to stay in power. And so you get fiscal policy. And before the Fed was independent, maybe you had a helping hand from the Fed at that point as well. And that's kind of that 4-year cycle. And we're in year 4, of course, and it tends to be a positive year. And so far it has been. And year 3 is probably the most positive year. And the market was up 20% or so last year. And there's an interesting angle here, because if you dissect the 4-year cycle and isolate only those occurrences when the midterm year was a down year, so 2022 was the midterm year, and it was, of course, a down year. Following that part of the cycle, the market does very well in the subsequent 2 years, and the market is following kind of that roadmap, very, very closely. And so then there's the question, of course, of who gets elected, what policies get enacted. I think politicians like to take a lot of credit for the things that happen in the markets, but remember, the S&P 500 is $41 trillion in market cap. GDP is 28 trillion. These are big numbers, and the economy and the markets tend to do what they do, which is not to say that the election doesn't have a meaningful outcome. But if you wait long enough, the differences really kind of dissolve. And one thing that I've looked at is, when you have an election cycle, what happens to the market based on different outcomes, right? So one party sweeps all houses in the White Houses. You have gridlock. You have this party. You have that party. And there's a lot of dispersion in the first 2 years. But one of the brilliant things about our system here in the U.S. is that you have those midterm elections that will often course correct maybe an extreme outcome in the presidential election. And that midterm tends to kind of wipe the slate clean a little bit. And so when you look at different outcomes of different election results and you measure it over the full 4 years, the outcome is almost identical, regardless of which party got elected, what houses do they control.
Wow.
And so it shows you that if you wait long enough, this stuff doesn't really matter. Obviously, at the sector level, it does, right? I mean, if a certain sector is regulated or not regulated, there's going to be winners and losers. But at the overall level, it tends to kind of work its way out.
So if this is year 4 of the election cycle, this is going to be the good. This is going to be the good year. Next year, not going to be so good. Are you anticipating a crash? And I ask that cautiously because honestly, I mean, at this point, if we were to have a significant enough of a decline, they're going to rush in and monetize the debt if they need to. I mean, if things really started to come undone or there was massive treasury dysfunction, they're not going to allow that, right? So, I mean, all roads lead to printing, don't they?
Well, I don't like to use the word crash, and of course, I don't expect any crashes, but it is entirely plausible that the recession that we were all expecting last year, after that inverted yield curve, that it comes next year, and recessions do come eventually, and it's not the end of the world. I mean, recessions and bear markets, they kind of wipe the slate clean, and they level set, and there's something healthy about that, even though it certainly doesn't feel good in real time. I mean, you think about all the Bitcoin winters, right? Like that, like it shakes the tree, and all the tourists, leave the building, and then you have kind of a pure market again. So that there is, it does serve a purpose. But if we had a recession, let's say in 2025, which is not a prediction, but let's say it happened. We can count that the deficit, which is already 6-7% of GDP, would go up a lot, right? Yep. I mean, there would be more spending, and the GDP would shrink because you have a recession. So the deficit as a percent of GDP would go up substantially. It would probably be more than 10% of GDP. Then it's a question of what does the Fed do? The Fed has had the luxury of the last couple of decades of inflation underperforming its target, right? The Fed has a 2% inflation target, and the inflation rate until a few years ago was below that. So whenever you had a shock to the system, a recession like the financial crisis or what have you, it could go to zero. It could do QE, print money, and no one really had to worry about inflation going off the rails. I'm sure they worried about it, but it never happened. So the Fed's dual mandate, right? Full employment, 2% inflation. We are at 3.9% unemployment, and inflation is around 3.5%. So let's say we have a recession next year, and the unemployment rate goes to 5 or 6, which would not be unheard of in a recession. Mm-hmm. If inflation is still at 3, like what is the Fed going to do? Like its two mandates are in direct opposition of each other, right? Now, it would clearly ease policy. I don't think there's any question about that. But they wouldn't go to zero if inflation is stubborn at 3%. Maybe they go to 3 or 2. Well, you would create negative real rates in a recession. I mean, that is the whole point of loose monetary policy. But it would limit how much they can do. They might do QE, but anyway, to your point, you would have an easing Fed and a ballooning deficit happening at the same time, and then it's a question of, does the market look through that, saying, well, yeah, that this is in a recession. The recession will end in 9 months, and therefore, whatever this is, it's not going to continue. And that's an important thing to think about, because if you're going to buy a store of value asset, a long-term asset, you would need whatever the catalyst for that to be sustainable, all right, or to have a long shelf life. And that's one thing that was interesting with COVID, is that we saw that ballooning money supply, but it shrank fairly quickly, right? That rate of change went from like way plus to way negative. The same thing happened in the 40s with the war, right? As soon as the war was over, the government ran surpluses. I don't think that's likely anytime soon, but it corrected that spike in the money supply, and that's why inflation never kind of got unanchored in that period. But if you take the 60s and 70s, the money supply grew ahead of its trend line. I mean, the money supply is always growing, right? In the same way that GDP is always growing. Part of that is inflation. So the fact that the money supply is growing on its own is not alarming. It's if it's growing well above its trend line of about 6%, then it's alarming. And in the 60s and 70s, it did that for years and years and years. And that's why we saw, the end of the Bretton Woods and gold and all of those things happen, because that was a structural move. So to kind of loop back to your question, if we had a recession, there would be money printing, there would be higher deficits. But I think the market would ask, the market would ask itself if it can look through that and say, okay, if that's just going to reverse itself when the recession's over, I don't think, that's going to take gold to like 5,000, right? But if the market believes that this is an unsustainable path that is going to end up in some sort of debt crisis, then that's a different story.
I just wonder when the market will see all of this as unsustainable, the amount of debt that we're in, the fact that there is so much manipulation. And I really do see Bitcoin as being one of the only assets with true price discovery, because around it, yes, we've had CPI of about 2%, but you just mentioned it. Money supply has been going up at 6, 7, maybe 8% annually, and all of that's been flowing into mainly equities and real estate, which is why the prices of those for especially young people feel so out of reach today. And there's this massive wealth concentration that has developed that people are obviously frustrated about. They're venting those frustrations politically. So going back to Bitcoin, I'm kind of curious where you think we're at in this cycle, because I saw that you said possibly 7th inning. And I feel like this bull market has barely even started, especially when it comes to retail interest. And it does not feel like it did in 2021. So where are we at? 7th inning, really?
No. So my 7th inning thesis is about the stock market cycle.
Oh, so not Bitcoin.
No, that's not Bitcoin.
Okay.
So I call it the 7 and 7 market, and I never had a 7-7, but that's an old cocktail from our parents' days, like Seagram's and 7 it was. But so I call it the 7 and 7 market because I think cyclically the stock market is in about the 7th inning of a cyclical bull market, and I think secularly we're in the 7th inning of a secular bull market that, in my view, started in 2009. But so that the 7th inning comment is about the stock market. For Bitcoin, where we are in a particular cycle, who knows? It is such a unique, asset. But when I look at that S curve, right, that exponential growth curve, and I've created a lot of models based on supply, the relative stock to flow of Bitcoin versus gold, and knowing what we know about gold, what does that then mean about Bitcoin? And my sense is that, Bitcoin could take market share from gold because it has more exponential features. So we can certainly talk about that. But when I think about what explains Bitcoin's price, I come down to two things. One is the growth of the network, right? So, people on X deride me for using, addresses as a measure of the network, but it's the only numbers I really have. So I look at non-zero addresses, and that curve is still growing, quite rapidly, but not as rapidly as it was, let's say, 5 years ago, right? So the nature of an S curve is that it starts to level out as the asset or the technology matures. And we've seen that time and time again throughout history. You can think about internet adoption a couple of decades ago, or mobile phones, or the number of TVs in households, or radios, or railroad miles, and they all follow that same path. So I do think Bitcoin has entered the more mature part of its curve, right? It's already 15 years old. And so the curve is still growing, but the rate of change is not as robust as it was. And that makes perfect sense. I mean, this is an asset that is maturing, right? Every asset matures. I mean, when gold became freely tradable in the early 70s, it was like a teenager. I was all over the place, and now it's like an adult, right? And so Bitcoin is sort of following in those same footsteps. But when I look at what explains the price? It's two things. It's the size and growth of the network, and that's why I track the addresses on a weekly basis. And it's monetary or fiscal policy. It's the amount of money in the system, and you can measure that as real rates is one proxy for that. You can measure it as money supply growth. But to me, those two factors explain like 90% of Bitcoin's price action. And when you put those together in a regression, to me, Bitcoin right now at its current price is trading. So when was it? A year ago, it was below this band that I just described. Now it's right in it. And the band is rising, right, because that network curve is still growing. But to me, Bitcoin is kind of where it should be. And a year from now or 2 years from now, it may well be higher based on those metrics that I just measured, but it's kind of crawled into the fair value range. So so I don't want to put an inning on it, because this is a structural story, a secular story, and the asset is only 15 years young in that story. So in that sense, it could be early innings, but like the eighth inning is not going to look the same as the second inning, because that demand curve grows more asymptotic as it gets older, or as it gets more mature.
Okay, interesting. Yeah, I mean, I look at Bitcoin right now, and we've gone up so much, absolutely, over the last year, and the ETF approvals helped with that. But we've been consolidating for a while, and I'm just curious where we go from here. I am surprised that we haven't hit six figures yet. I'm curious if there's going to be some sort of blow off top before, another massive correction. And I just feel like a lot of us are in sort of this holding period. Do you sense that too?
Yes, I do. And I think, I like to treat Bitcoin. So we're used to getting this sort of instant gratification, right? It's like, it's boom bust, and we're either losing our shirts or the thing is mooning, and so it's so part of growing up, I think, means transcending that dynamic, and so I think it's a good sign that it's becoming kind of frustrating, where, oh my God, I'm used to like seeing much bigger moves than that. And to me, this is a sign of maturity, right? I mean, as adults, we don't behave the same way as we did when we were teenagers or kids. We're more rational about it. And, you do have a two-way market now, right? You have a futures market where if someone decides that Bitcoin's gone up too much, they can short it. Or it's, the early days of Bitcoin, there was really nothing like that, right? I mean, somebody would buy it and there was no way to kind of counteract it other than selling long. And so you have a two-way market. It's now 15 years old. It's now democratized. You can buy it with the click of a mouse, and you own the spot. And that's part of the adoption curve, is that it grows up and it becomes less volatile, and less volatility means, fewer crashes, but fewer moons as well. And I think that's a good thing. I think it should look more like gold as it grows up, because if that is the story, right, if that's the value proposition, is that this is a store of value in a world of, maybe reckless, money printing, or however you want to call that, then, you want your store value to behave like an adult, not like a teenager. And I think that's a good thing, right? And just to come back way at the beginning of our conversation about adoption, this brings me kind of to this question of, when are corporations going to put this on their balance sheet, for instance, right? Well, if you're a corporate treasurer, are you going to put a 70 vol asset on your balance sheet in lieu of having cash that you need to use to make payrolls? No, you're not going to do that. You can't risk that kind of volatility if you need that money to pay your bills or to pay your employees. But if Bitcoin becomes less volatile and more mature, its Sharpe ratio can stay exactly the same, right? But the numerator and denominator both shrink. then you start having that conversation. Say, okay, maybe this is actually a viable asset even on a treasury's balance sheet. But so I think it's all good that this is happening, even though we're used to the fireworks and we're not getting it anymore.
Yeah. Well, it's interesting to think about because we are still so small. I mean, 1.2 or $3 trillion market cap compared to gold, which is probably a little over 12 trillion, right? Yep. So we could still 10x from here, which would be really, really nice for the Bitcoin holders. And people think that it could go far higher than that. But you're right. I mean, in terms of just the maturing of the asset, we have seen a little bit less of those massive price moves. But as we start to wrap up, I can't help but think about just that. You love zooming out and just thinking about that bigger picture of where we're at, why so many people are turning to Bitcoin. Obviously, gold has been that traditional store of value, but I would argue that for the most part, it's been able to preserve wealth as opposed to generate and create a lot of wealth for people maybe newly coming into the asset. And people are looking at Bitcoin as this sort of not just store of value, but supercharger of value so that they can accumulate and maybe catch up in a way that they've felt disenfranchised or left behind by the traditional system. So can you kind of wrap up with your thoughts on, are we at an inflection point where things are changing? The 60-40 portfolio that we touched on earlier, people looking to alternative assets like Bitcoin, grasping sort of for hope so that they can plan for their futures financially, especially young people, because so many feel like they're sort of treading water and not able to get to that next level to be able to provide for themselves and their families.
It's a great question, again, we do have to be cognizant that with that upside return comes volatility. And so if you're a young person and you are just getting started in the job market and you're saving through a 401k, or some sort of dollar cost averaging, I think, adding Bitcoin to the menu makes a lot of sense. And then it's up to the individual to decide, how much, and obviously it's the responsibility of that person to understand what it is, right? You don't buy something just because it goes up. That is the worst reason to buy something. And if you dollar cost average, the nice thing about that is that you're never buying the high, you're never buying the low, but you're just slowly accumulating. And it's a great way, not just for Bitcoin, but for any asset class to invest. I mean, dollar cost averaging plus compounding are like the eighth and ninth wonders of the world, right? And so, comparing the traditional financial landscape now versus a few years ago, I mean, the good news for any investor, including a young one, a young person starting out, is that, bonds, maybe they're boring, maybe they're for like our grandparents or whatever, but they at least offer value as of today, right? Inflation's at 3.5, bonds are 4.5. You're getting a positive real yield. They're not providing that negative correlation. And of course, the risk is that down the road, that yields will be higher in this era of fiscal dominance where the government has to finance its deficit. And right now, the Fed, nor the People's Bank of China, nor the Bank of Japan are stepping in to buy these bonds, right? So there is a risk that yields go up from here. But, equities are a proven compounder. Real estate, of course, which, as you mentioned, is sort of out of the reach of many people right now. But there are still traditional asset classes that do that, even in an era of higher inflation and fiscal dominance. So I want to make sure people, a balanced portfolio means a balanced portfolio. So you don't want to bet everything on one thing when other asset classes are valuable ones as well. So for me, having the right amount and not betting too big, but having enough that it makes a difference, to me, and again, I sound like a total TradFi person, but to me, that is a very it's very important to keep that all in mind, right? We can't just look at the numerator of the Sharpe ratio. We have to look at the denominator. And with Bitcoin, a little bit goes a long way. And what you want to do is you want to generate positive real returns, right? Inflation is the big valuation killer for any asset class. And we saw that just in the last few years. So you want to achieve positive real returns through a diversified portfolio that if one thing is getting pummeled, your portfolio doesn't go down so much that you can't sleep at night, and then you sell everything, and then you're even a worse point, because then you're not compounding anything if you're on the sideline, right? So having that balance, I think, is very important, whether you're older or younger. But the goal is to achieve positive real returns.
Well, you're certainly right that a little bit of Bitcoin does go a long way. I respect your very measured approach. There's a lot of things on the menu to choose from today, but I've really enjoyed this conversation. Jurrien, where can people find you?
I am on X at Timmer Fidelity, as well as LinkedIn. I think I'm the only Jurrien Timmer, so if you just search for me there, you'll find me. And I produce a lot of charts. Charts are my thing, and you can find just about all of them on those two platforms. And every Sunday I write a report, like a newsletter that goes internally to my colleagues here, and a mostly unedited version of that goes onto LinkedIn Monday morning with a link to X, so you can kind of cross-reference it.
Perfect. We love your charts. I'm going to link your work in the show notes. And thank you so much for joining me. I hope to have you back on soon.
Great. Thank you, Natalie.
Thank you so much for checking out this episode of Coin Stories. If you're listening on the Fountain app, you can show your support and share your thoughts by sending a boost. Last month's top episode was with Michael Saylor at Michael E. Sparks, boosted 777 sats and said, "We're still early." Another popular episode was with Ed Dowd at Justin Affronti, boosted 500 sats and said, "Paul Ryan actively talking about US CBDCs, and some folks think it won't happen in our lifetime. Gradually, then suddenly." Great job, Natalie and Ed. Thanks so much, Justin. I love reading and replying to your boosts, so download Fountain on iOS or Android today and make sure you're subscribed to Coin Stories. This show is for entertainment and educational purposes only. Nothing should constitute as official investment advice, and you should always do your own research. My inbox is open if you want to share feedback or guest suggestions. Just reach out at Natalie@talkingbitcoin.com. I'll see you next time.